Hello and welcome once again to Untold Wealth. Again, our second episode, we're in person and we're ready to chat about the hottest economic topics, the
Ooh.
most interesting and not boring topics you've ever heard of in your life. Wink, wink, nudge, nudge. Today's might be a little bit more boring than usual. Today's episode is probably going to be the most lecture style episode we've ever had.
I love it. Okay.
Um, yeah, let's make sure my mic here is all good. There we go. Vince, fix that mic noises in post. Okay.
Yes, sir.
All right. We're just about ready. I have a whiteboard right here. We're ready for a lecture.
I'll get my notes ready as well. I'll start jotting
Get your
stuff
notes
down.
ready. What do you think is behind this board, Vince?
Oh, wow. This is some real prices right. I think behind this board is like some murder mystery type thing where there's a bunch of strings going everywhere, connecting to like different papers. That's what I'm imagining is behind this board.
Like the Pepe Sylvia meme from Always Sunny in Philadelphia. Yeah, with Charlie Day.
Exactly. Exactly.
It is not anything close to that, but that
Okay.
is a funny bit, which I think we should explore in the near future. It'd probably take me a good hour to set up something that looks sufficiently chaotic and fun. But okay, it's not that. Let's take a look at what's behind here. Price is Right style.
Drum roll, please.
Oh, okay. Ugh,
Oh my
look at
God.
that. Look at that.
Wait a
Okay.
minute. Hold
So
on.
I hope we can see at least some of the words on this thing as I try to balance it.
Yeah, I feel like I'm at
It's a
an
little
eye
bit
exam a
skewed.
little bit, where it's like,
Okay, I've tried to bring it as close to everyone as possible. Okay. So what we have here is essentially what I'm going to be chatting about today, and that is the world of bonds and government debt.
ooh, so
And
sexy.
it's the sexiest topic you could ever imagine in the world of finance and economics. But it is so incredibly important. And I think a good 15% of the world's population, probably less, 10% maybe, actually understands bonds and yields and like government fiscus. So I think it's so incredibly important for me to kind of break this down in a way that is not terrifying,
Okay.
so that when you hear at a family function, at a dinner, people are talking about budget deficits and yields and bonds, you can have the knowledge to say, oh, I know that, and then leave because they are probably having a very boring conversation.
Yeah.
Okay, let's get into it. Vince, you actually have an incredibly important role in this episode. I want you
Okay.
to ask the questions that our audience will have.
I'll do my
Okay.
best.
Okay, great. Audience, don't worry about, or listeners rather, if you can't see the board, I'll try to explain it to you as we go. Okay. Vince, what is in your mind a bond?
A bond is essentially an agreement between you and somebody, where maybe you give them a bit of money and they promise you that they're going to give that money back with a little bit extra later down the line.
It's literally perfect. It's literally spot on. Okay. So let's dig a little bit deeper into what you've said. Okay. Typically, when people refer to bonds, they talk about government bonds.
Mm-hmm.
The government is saying, hey, specifically, the government's treasury is saying, hey, we need to get money so we can do cool projects in the future, build bridges, roads, subsidize, stimulate the economy, pay their workers. I don't know. They just need money essentially. They're saying, and this is what they do, they auction bonds. They are regular auctions. Sometimes they will have like 15 auctions within a month for different types of bonds, and we'll get to the types a bit later.
Oh,
But generally, there's kind of one big auction every quarter, I would say, but that fluctuates from country to country.
sure.
Okay, so they're auctioning bonds, And we're not going to get into the auction design of the bonds. Needless to say, it's a little bit complicated. But we're going to be chatting about the types that they're auctioning and who's buying. Okay,
Okay.
so let's talk about types of bonds. Okay, there are three generalized types of treasury bills bonds. They can be hyphenated to be like called like T-bond, T-bill, T-note. But as you see here, I have small t and it's getting bigger and bigger, and that represents time. So the time horizon is getting bigger and bigger between these, okay?
Yeah, for
So
the listeners, there's bills to notes to bonds. And they're
yes,
progressively
it
getting
goes from
bigger.
left to right.
Yeah.
And the T above them is getting bigger, right? And then below each we have C, which is typically this coupon rate we'll be talking about. But that's kind of how bonds pay out their investors, whoever buys this debt from the US government, okay? Okay, let's start at the left. Bills. Bills, they are your shortest term bond that you can buy from the government, let's say. Generally 1 or 2 years, and you between then you get some coupon payments and then the maturity value, which we'll get to. Notes, I would say between 2 and 5 years, and then bonds are anything 5 years and above. Typically, the highest a bond will ever go will be 30 years. Okay. So you can have a very long-term time horizon if you want to purchase bonds. Yes. Cool. So why is time horizon and the C coupon payments so important? It has to do with how bonds pay you out. If you purchase a bond, bill, or note, you purchase it for what is called a principal price. Okay?
Right.
Let's make it easy. Let's say $1,000. Okay?
Mm-hmm.
You give the US government $1,000. They give you a sheet of paper that says at the end of the time period, the T, 2 years, 1 year, we're literally going to give you that principal back. We're going to give you $1,000 back. So it's actually a pretty sweet deal, especially if it's a low time horizon, because you're going to get your $1,000 back pretty soon. But to incentivize you to buy it even further, what they do is they give you coupon payments generally every 6 months until the end of that time horizon. Let's
Gotcha.
say 2 years. So if you purchased a bond for 2 years, you'd get 4 coupon payments, one every 6 months.
Yeah.
And then at the end, you'd get your $1,000 back. They'd be like, cool, thank you so much for investing in the US economy. We will see you at the next auction. Okay. So it's very, very important that people want to buy these things. And we're kind of going to get into that. Okay. So that's the lay of the land with bonds. We're going to chat about one more very important, well, I don't know, very important, but it is a phrase you're going to hear often, which is bond yields. You'll hear it in any yield, in any discussion, okay? Especially in economics. We don't get, when I was studying economics at university, we don't get the biggest financial kind of theoretical background. All we essentially get told is that bond yields are inversely proportional to bond prices.
Yes, I vaguely
Do you
remember
remember that?
this. Yeah.
Do you remember that? And all it is literally saying is it is a calculation here. It is the yield is the coupon rate, let's say 4.5% every 6 months of a $1,000 bond you purchased,
Mm-hmm.
divided by $1,000.
Right.
That's it.
Because the price, as you put at the very top there, is the same as the principal that they bought it for.
Yes, at first purchase. Yes.
Gotcha.
Yes. Now, the reason I didn't put principal down here is because there is a secondary market for bonds. The
Oh, of
primary
course.
market is that first auction when you go and purchase from the US government. The secondary market, this is the world of finance. People want to trade and sell bonds because they want to be more liquid now, because bonds are a very illiquid asset. They want to say, okay, I have a 30-year bond. This is its yield right now. Listen, can you buy it from me for X, Y, and Z funds, right? That's why there is a secondary market for bonds. The buying and selling of US debts, US securities. Okay. Bonds are a very simple but complex mechanism because they very much tell us the time value of money. This is an economic concept. It's essentially saying that money now is worth more than money later. All
Yes.
right? In a general sense, because money later is subject to inflation and you can't invest it now to gain interest on it to counter that kind of inflation. There's a few more things that go into it. There's also this human kind of concept of I want things now and not later,
Makes sense, yeah.
which isn't strictly financial. That is certainly a human behavior that people, we're so back. Sorry, we just had some technical difficulties with camera angles. Okay, there's the time value of money that comes into play with bonds, but that comes into play with any
Investment,
asset,
yeah.
any investment. You want it, you'd prefer it now, basically. Okay, I put consumer sentiment here, and this is kind of a catch-all phrase that economists say. It's pretty much how the market feels about bonds at any given point, given what politicians and governments are spending money on and their
Yeah.
debt. All right, which is going to become very, very, very important in a bit. All right. There's also a term called spread. Okay.
Mm-hmm.
So this I wouldn't say is necessarily important. People talk about yield spread and credit spread, and the more I research this, the more it feels like a finance psyop to get people disinterested in the topic of bonds.
Yeah.
When you think about spread, all you're thinking about is that the US government has bonds that have a coupon rate of 4.5%.
Right.
Okay? But the Indian government has bonds that have a coupon rate of 7.5%. There is a spread between these two instruments. Okay? And this kind of theory of money and finance says that the spread, as the spread goes to kind of instruments with higher interest rates, it is
Right.
necessarily more risky because they have to incentivize people to buy their instruments,
I see. I see.
their bonds.
Yeah.
Yes. So spread, it gets a bad rep. People don't know what it means, but that's pretty much all it means. The higher interest follows the riskier kind of options
I
for
think at this
investors.
point as well, finance and like gambling get more and more intersected in this Venn diagram a little bit because you have betting spreads and stuff like that, and it really gets into the semantics of like, okay, we're weighing risk and reward here. What is better to invest in terms of like a long term perspective? Yeah, this is where
Yeah,
my
yeah.
knowledge starts to peter out.
Yes, but it's a perfect comparison because it really is a bit of like high stakes betting.
Yeah,
It's weird to say that the world is kind of functioning, the finance world is functioning off betting, but that's essentially what it is.
yeah,
I can bet that a stock is going to fall, and that's why I'll buy insurance on it, you
uh-huh.
know? It's so weird to think of it like that. But how economists, statisticians view it is that if you buy insurance for yourself, you are pretty much, or let's say if you don't buy like health insurance for yourself, you're betting that you won't need to go to the hospital in the near future.
Exactly.
You're
Yeah,
you're make you're making a bet. I don't know. Most people don't view it like that, but from that perspective, yes, it is.
yeah. I guess.
Okay.
Okay, go on.
Now, before we go further, do you have any more questions? Okay.
No, no, I think so far, I think thanks to, having studied this a little bit, I have a little bit of an upper hand in understanding where this all
Yes.
kind of comes
Yes.
together.
I want you to dumb it down even further. I want you to ask silly questions
Okay.
if you feel the need.
I
Quote
I
unquote silly questions.
I'm just curious, like who's really buying these bonds? Is it your like average Joe or is it businesses? Is it other governments that are buying these? Like what's the market for this?
It's such a fantastic question. It's a fantastic question, and I have it right here. It's the market for bonds.
Oh.
we've said that the US auctions it. I know you can't read it, but hopefully the audience can read it. The market for bonds. There are typically three kind of entities that purchase bonds when they go on auction. It is, as you said, foreign governments.
Gotcha.
This is a big one. This is a big one, and in the past, it has been even bigger for particularly the US economy. All right? They will purchase US bonds because they see it as a kind of safe haven to keep their money. It's in dollars. The US has never not paid off their bonds before, which is something incredibly, incredibly important to note. So it is seen as very safe. It's never not happened before. Then there are firms. Okay. These are big, big ticket firms that need places to put their money for long terms and get interest back.
Gotcha.
Okay. There we go. And now individuals. Individuals do not get invited to the table at the first auction.
Okay.
They simply don't. The way that the auctions are kind of designed is that you need a lot of money to be able to have a seat at the table. Um, and there's a big process towards like getting registered, essentially. Individuals do play a role in the secondary market for bonds. When this auction is done initially, and then they go, okay, maybe some of these firms say, we need money right now. Let me sell some of these illiquid bonds, these
Mm-hmm.
bonds that only pay me out later. Let me just try cash in now because whatever, the business is doing badly right
Yeah.
now,
You don't
or
want to wait
they
10
have
years.
opportunity. Don't want to wait 10 years. Okay, so individuals can play a role there. Now, there's also there's also a fourth buyer. And the fourth buyer is the most controversial. The
Okay.
fourth buyer is the US government itself.
Ah, so
It is the central bank.
they're buying their own bonds in this example here.
So there's the treasury that sells the bonds, then there's the central bank, which has the role of price stability and promoting employment. Okay?
I see. Okay.
Okay, it gets complicated, and this is why it's controversial. Okay? What they are doing essentially is bolstering the US economy by printing money and giving it to the US Treasury.
Okay.
That is what they are doing. What it's called is called quantitative easing.
Right,
If you've
right,
ever
right.
heard that before,
Yes, I have.
they are buying bonds to give money to the US Treasury, and they are saying use it to stimulate the economy and give us the employment, which is our mandate.
Right.
Now, it kind of runs counter to their other mandate, which is price stability, but sometimes they do have to step in and stimulate the economy. All right. So
So,
there's a fourth buyer there, which is like another entity of the economy, of the
gotcha.
government.
I'm trying to form a question here in that, like, the money, like, they're giving them the money, but that's not necessarily going into the economy directly. I guess once they receive the money, they're going to spend it on like public works and stuff. But why would they go through this roundabout process instead of just like printing the money and giving it to them, if that makes sense?
I don't actually know. I suspect it's because it looks bad. Well, there's probably a few reasons. One of the reasons is probably because it looks bad when there isn't sufficient demand for bonds.
I see. Okay.
So the government, or the central bank rather, actually doesn't participate in the primary auction. They will scoop up bonds from a secondary market, the
I see.
secondary market
I
rather.
see.
So they will like try and like say, hey guys, people are buying the bonds. We are buying. We are buying them. You guys should buy them at the first instance because we can buy them at the second instance, to
Mm-hmm.
prop up
Mm-hmm.
demand and make them kind of like worth more. That is how I've kind of wrapped my head around it.
Yeah. I mean,
It's a
it
bit weird.
no, but it makes quite a bit of sense. And I can also see like how for firms, it's quite a cool tool because like if the market's in kind of a downturn, you have a stable investment here from like if you go for just bills, for example, and try and ride it out. And then if you want to liquidate it and get a little bit more cash, you just sell it on the secondary market. So it seems like a nice stable investment for all these individuals at
Yes.
least.
Yes. Yes. And yeah, sometimes they're dealing with such large amounts of money that they can't put it anywhere else. They can't put it in a high interest like fixed deposit with a bank because the bank will say no, it's just too much money that we'll have to spend giving you this money back. The bank will go and use that money essentially to buy bonds.
I
So they just
see.
say, let me skip the bank and let me go
Let
buy
me
the
just go buy
bonds.
bonds. Yeah. Okay.
Let me just go buy bonds. Exactly. Yeah, exactly right. So when you're dealing with such large amounts of money, it's like safer. The returns are pretty good if these coupon rates are not terrible. Yeah. But okay, this is how it's supposed to work. The government is supposed to get this is yeah, the
I
government is
see.
supposed to get these funds and it's to say, okay, we're in debt. We have to pay people off 10 years, 20 years down the line, you know?
Hmm.
And we've probably been running these auctions for the past 50 years as well. So we
Yes.
have debts we need to pay even now.
Lots of
So
debts.
there's a debt cycle. So a government essentially has to run the calculation of we need to get return on investment when we're selling this debt. We need to really put it into the economy, make it bigger, make it so we can generate more taxes so that we can pay off more debt and make our people happy in the now.
Yes.
And you can see how trusting a government to do that responsibly is a bad idea. Is a
Yeah.
bad idea.
Because
Because, yes, go
I
on.
I was gonna say, Kim, because in my mind, especially I think nowadays, governments I don't think are as far reaching in their thought when it comes to these sorts of things. It's more kind of like, okay, in the next 4 years, how can we make the people happy? Rather than in 30 years, we have all these debts that we've accrued that we want to build up enough to pay off down the line, if that makes sense.
Yes. I mean, that is the general kind of sentiment with governments is that they are far too short-sighted, but they're not short-sighted because they are like silly. It's because their incentives are to make the population happy now so that they get the votes in 4 years, so that they
Yeah.
can be there again and make them happy now again. Okay. So there's a vicious debt cycle. If they don't get their return on investment, they are in trouble. And I'll get to some stats in a bit. Okay, but let's paint the whole picture before I start saying, oh, it's a bit dicey. Okay, so let's run through an example. Okay, let's run through an example. You read a headline today.
Hmm.
The headline says yields spike. They are running away from US bonds or something quite dramatic like that.
Gotcha.
Now, armed with what we know now, we can see what is happening. Yields are going up, okay?
Hmm.
Yields in the secondary market in particular, okay, are going up, which necessarily means because coupon rates are held constant, the coupon rate of the contract is always 4.5% if you purchased it in the primary auction.
Okay.
It necessarily means that prices are going down. People are paying less for bonds, okay? So prices are going down. So yields, the return that they get for holding lower bonds, because the price is lower,
Hmm.
is higher. It's
Yes.
literally just a function of that, of the maths.
Understood.
And if we want to phrase it perhaps a bit differently, you can think of it that the yields are increasing because yields are just return. If I purchase something for a lower amount and it's still giving me a 4.5% coupon rate, I'm getting higher return on it.
Yes. Yes.
But maybe
Yes.
something is spooking people so much that higher yields, you know, aren't like getting it back to an equilibrium, essentially.
Right. So, okay, I'm just gonna. I think I'm a little bit lost there. So,
Yeah, sure, sure. Yeah, go for it.
people are getting spooked, and so they're willing to pay less for these bonds or these notes or these bills or whatever. the like
Y-
price is never going to change. And so who's offering the higher yield? Is it the government or is it just a function of like the market?
So no one's offering yield.
Hmm.
Yield is just a calculation.
Oh, I see.
Essentially, prices decreasing because demand for the US bonds is very low. Okay.
Okay.
Why might price be decreasing for US bonds? Because people are really worried about the US
Paying it
not
off.
paying their
Yeah.
debts, for example. Okay? So they
Hmm.
go there's a fire sale. Everyone's selling. Bang bang bang. The prices are decreasing. Everyone's selling them. They want to really incentivize people to get this debt off their hands, so they're making the price cheaper so that others can buy it.
Right.
Okay? Yes.
Okay.
And
Um,
people are kind of incentivized to buy it from them because the yield is going up, their return.
the
It's
value
actually
is more.
becoming a better and better deal for them to buy it as that price is decreasing.
I understand.
Yeah,
Okay. I'm following
yeah.
now.
Cool, 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 cool. So now, using that mechanism, whenever anyone chats about it at a party, you can say, okay, well, they're fleeing. If the yields are increasing, it means the prices are decreasing, which means there's less demand for the bonds, which means people are fleeing the bonds for some reason. And usually in that article, it'll say, oh, the US debt to GDP is the highest that it's ever been, or that another bond is looking far more secure on the other side of the
Hmm.
globe, and they are
Yes.
going to that. And
This,
usually it's a combination
I see. Yeah.
because of that spread, because of the spreads. Usually it's a combination of the two.
So people are looking elsewhere. They're like, okay, we don't trust the US government as much, maybe still somewhat, to pay off these debts during the next debt cycle comes to a close. And they're like, okay, maybe the EU's bonds are looking better, or India, or wherever else potentially.
Yes, yeah, absolutely. And you're absolutely right. And trust is the operative word.
Yeah.
Okay, let's get into the nitty gritty. Let's get into a little bit of contemporary news.
Okay.
Okay, Liberation Day. Trump
Mm.
announces pretty much blanket tariffs on like nearly every nation on earth for some reason. Okay. He calls it a trade deficit, but it's rubbish. You can trust me, there's no reason why a trade deficit is necessarily bad for a nation. It
Mm-hmm.
just means you have a stronger it just means you have a stronger currency and people don't want to buy some stuff from you. But you have a strong currency, so it's really a good deal to buy from other nations. But anyway, I digress, okay? Yeah, Liberation Day happens. Trump, he's pulling the trigger on so many things, and essentially, people are saying, whoa, the US economy is about to implode. The US economy is about to implode. And what happens? A rally away from US bonds. Okay. People run to Swiss bonds, which are seen as incredibly, incredibly safe as well.
Makes
Switzerland,
sense. Yeah.
famous neutral, and German bonds, surprisingly. I'm not too sure the history of German bonds, but they also saw a giant increase in price because demand for them went up and thus lower yields
Yes. Yes. Yes.
because their prices are so high now in the secondary market.
Yeah.
Okay. And there's a lot of speculation as to why Trump put the 90-day pause on Liberation Day, essentially. And the biggest reason, the biggest theory, and I think is true, is because the Treasury Secretary rather, Scott Bessent, chatted to Trump for like 10 minutes before he got on a flight and said, people are losing confidence in our bonds. You
Yeah.
have to stop this. And so he immediately did. He immediately did. So, what if Trump didn't stop it? What would happen is people would lose trust in US bonds. Therefore, when they did the next auction for US bonds, they would have to increase the coupon rate to say, hey, people, come buy our bonds. Okay? They give you great return. But remember, when they give great return to people buying them, It means the US is getting more in debt. They no longer have a way to cheaply grab money from people
Yeah.
to fund projects now. So it's a terrible, terrible, terrible thing if your bonds make you bankrupt. It's terrible. You can't fund future projects. You just can't. They're getting more expensive per bond you buy if people are running away from them. So this is pretty much why Trump stopped his crusade, at least for a little bit. Okay. So if you have any questions, Vince, go for it.
Yeah, I mean, it makes sense. I'm glad to hear at least that they're still so, stringent about it, or that they have some sort of stability around that. Because potentially, if they wanted to increase the coupon price, it would only be a problem to them 4 years down the line, 5 years down the line, maybe even 30 years down the line. Because for a little while at least, they wouldn't be needing to pay off those higher coupon priced debts. So I'm happy to hear that they've, at least adjusted in that sense. But yeah, that makes complete sense.
Sure, sure. Okay, I'm gonna read some stats, and this is essentially why the US was terrified of people fleeing their bonds
Mm-hmm.
and thus having to incentivize them with higher coupon rates for
Okay,
their contracts,
I'm here
the
for it.
bond purchases. Okay, the US's debt to GDP is 122%.
Yikes.
So if the US's GDP is $100, their debt that they have to pay in the next probably 30 years is $122.
So their
So
debt is
they are
more than they're
like,
making, essentially.
their debt is more than they make per year, right? Not a good sign. Not a good sign. If everyone like wanted their debt back like today, essentially they wouldn't be able to pay it if they like sold their nation. I don't know, that's a bit of an overreach, but it's not a good sign.
Yeah.
And here, and I don't even think that's necessarily bad. But here's the tricky part. Their interest payments for each dollar they receive in revenue per year, the money that they spend just financing the coupon interest payments to all the
Mm-hmm.
people holding their debts, is 18%. For every $1 they receive, $18 straight from their tax revenue goes to paying people's coupon rates alone.
Geez. So before
Alone.
anything else.
before before anything else, before even their mature, because remember when it matures, they get that $1,000 back
Yes.
if they bought that bond. And that's not even including that. So
Yes.
18%.
Jeez, man.
Apparently at the end of 25, it's scheduled to go to about 18.4%. So it's slowly, slowly rising.
Yeah.
And that is the big kicker. It's money out of your pocket immediately. And that is why that coupon rate kind of example we had earlier is such a big deal.
Mm-hmm.
Yeah.
I think
Okay. Now, yeah,
I was going to say, like, that's so, like, nearly a fifth of their income, to put it in another term, is getting whisked away from them before they can even spend it. Which, in the
before
grand
they
scheme
can
of
even
things,
spend it.
might not seem like a lot, but I feel like when it comes to other things, like, you can't move that around. Like, you can't push that away to pay for a later date. That's just out of your bank
Yes.
account
And
straight away.
remember, if you don't pay for it, there will be riots. People will run away from the bonds faster than they can even breathe. They have to pay those interest repayments on the day every single 6 months. Bang, 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 bang. Or else people will leave. They will lose their way to essentially sell bonds because they'll only be able to appeal with higher coupon rates, but people won't trust them to pay those higher coupon rates. So it'll
Yeah.
be this horrible cycle. Yes. Okay. I also just wanted to say it's a very US focused, but bonds are very US focused in general because everyone loves buying US bonds. And that's who we're going to chat about.
Hmm.
Okay. So, of this $36 trillion in debt that the US owns, which is 122% of their GDP,
Yeah.
okay? 24% of these bonds are owned by foreign countries. So about a quarter are owned by foreign countries.
Okay.
Those countries are Japan, China, and the UK, like top three. Japan,
Mm-hmm.
China, then UK, but then tons of other countries underneath them. But those are the top three. All right. 55% are held by US investors and holders, so firms in the
Okay.
US essentially, and even some individuals in the secondary market. Okay. The Federal Reserve holds 13% of them. The central bank of the US holds 13% through that
Mm-hmm.
quantitative easing that we were talking about earlier. And then what is this? 7% is owned by like Social Security and US institutions.
Okay.
Yeah.
So like a majority of the bonds are owned by US entities, more or less.
Yes. Now, that didn't always used to be the case. I would say a good 20, 15 years ago, about 50%, close to 50% of US debt was held by foreign nations.
Hmm.
So there's been this downward pressure where foreign nations are less inclined to purchase US debt, US bonds, US securities, because for various reasons, but probably one of the big ones is that they're getting shafted with a lot of tariffs lately. And
Right,
they're just
yeah.
not interested in funding, yeah, people
So
that are giving them a bad deal.
it could also be, in addition to potentially not trusting the US government as much as they once did, it could also be kind of this like signal or statement that they're making in response to the policies that the US has put out.
Yeah, yeah. But I mean, this is the trend over 20 years. And I mean, tariffs have only had to happen in the past 6 months. But yes, there's good reason that people aren't purchasing as many bonds in proportion. Yeah.
Gotcha.
It's also probably US firms are so large nowadays. They're so big and worth so much that they also can buy a lot as well. So there's like probably both. Foreign governments are buying less, and US corporations have access to so much money now that they're probably buying a bit more. Yeah. So it's probably both of them. Yes. Okay. Pretty wild statistics. Now, I just want to put it in context and give you the South African statistics, or
Yeah.
at least some of them. So South Africa's debt to GDP is 77%. Okay.
Okay.
So
Okay.
notably better than the US, like
Yeah.
30 percentage points better than the US. No, more than 30
50.
percentage points better. Yeah, around about 50 percentage points better. Exactly. So that's good. But remember, the US has been the bond seller for the past 50 years, longer. So they have very cheap interest repayments. Okay, remember it was about 18 cents of every dollar they received went to interest payments.
Yeah.
Now, South Africa, with a lower debt to GDP, we've given out less debt than the US. We actually have a higher uh, debt repayment per 1 rand we receive in revenue. And that number is around 22 cents.
Okay. Okay. And that's because I imagine
Yeah.
our coupon price is quite a bit higher than the US's.
Yes, we have to incentivize people a lot more. We don't have cheap debt like the US because we're not as trusted as the US.
Hmm. And just out of curiosity, like both of these are around 20% per se per of the currency that we chatted about. So like 20% of the revenue that we get in and the US gets in goes to these interest payments. Is that like standard, or is it just a coincidence that they're both around 20% here for both of these countries that you mentioned? Like, is that a good
Uh,
interest repayment rate, or
I actually don't know. I don't know.
okay,
Yeah,
fair enough.
it's probably a bit of a coincidence, but I bet you every nation on Earth is probably paying at least 10 to 15 to 20% of every revenue to interest repayments. Every nation on Earth works on this debt bond recycle debt cycle essentially,
Yeah,
and it's like this balancing act. But the because of the nature of politics and how short-sighted they are, it's quickly tipping to a point of unsustainability. Yes.
yeah.
All
I
right.
mean, I remember briefly an earlier episode I took, we chatted a little bit about this concept of like inflating the debt away. I mean, we're kind of segueing into like, okay, this is becoming potentially an increasingly big problem. So, what solutions are there to it besides, God forbid, fiscal responsibility? Um, and I remember inflating the debt away was like one of those strange tactics that governments
Mm.
sometimes use to essentially make their repayments cheaper by making their currency worth less. Um, but I don't think that's like a viable solution to
We
something
we
like
we
this.
have chatted. We have literally described that today through quantitative easing. That
Yeah.
is inflating the debt away. It is driving the demand for bonds up artificially
Hmm.
by the Reserve Bank purchasing them. How does the Reserve Bank purchase them? They have to print the
Print
money.
money. Yeah,
They print money.
completely.
Inflation increases. The relative value of all debt in the country is now a little bit less
A
than it
little bit lower.
was
Yeah.
6 months ago. All right. So quantitative easing is probably one of those ways, maybe the only, I'm not too sure, of inflating the debt away, making that debt um, in real terms less weighty than it once was. So you can easily pay it off. But
Gotcha.
everyone in your nation gets screwed over
Yeah.
by inflation. So that's not a good solution. The
It,
solution is to be fiscally responsible and not get into a debt cycle in the first place and be upfront with your citizens who hopefully understand that, hey, these next 2 years we've lowered our government projects, so we spend less. Yeah.
yeah. Or at least
It's why yeah,
spent more efficiently, I was just gonna say.
bit more efficiently. And it's why this very recent Trump big, what is it, big tax bill? What is it called?
The
The big
the big
big bill.
beautiful bill or something
The
like that.
big beautiful bill. Because Trump, who's supposed to be a fiscal conservative along with a conservative, is saying, hey, we're going to add 3 trillion onto the US debt because we're planning to spend another 3 trillion. It's ridiculous. Yeah, feels like there's no end in sight, and it does feel like something's got to break the camel's back.
Yeah. Like conceptually that 3 trillion, you said, is that is for the bond market in particular, like they to fund those big projects. Are they
Yeah,
issuing more bonds, or is it just like,
they they're gonna have to pretty much fund those projects with bonds because tax revenue is something that's very consistent, you know.
yeah,
So it's like if they want to add even more, they got to finance it through debt.
crazy, man? I
Wild
mean,
stuff. Wild stuff. Okay. Yeah, yeah. One more question. One more question. Yeah.
no,
One
I
more
was I
comment.
was gonna kind of wrap it up and say like this is I think I've understood bonds a little bit more than I have ever through this little presentation. Um,
Yeah. Thank you. Me too. I've learned a lot.
like they're not as scary as I thought they would be, even though, because I feel like when you talk about bonds, either people get scared or their eyes kind of glaze over a little bit because you start talking about spreads and yields and all this different type of like
Mm,
financial terminology. But
yeah.
realistically, like if you understand other terms like the stock market and stuff, it's there's some
Yeah.
parallels there that you can kind of convert.
Yes. You're absolutely right. It is not as scary. If you've been listening to this episode and you didn't quite get it, do go and watch the video episode and take a look at, maybe I didn't explain yield correctly and you can like see the formula on the board. Um, but yeah, hopefully this explained it a bit better. I'm sure I will jump back to talking about Portuguese drug decriminalization in the future. But for this episode, I hope this has kind of wrapped bonds and the debt cycle into a neat little package for you, and you can avoid those boring people at family dinners, but feel proud about leaving, about ignoring them in the near future. All right, that has
Absolutely.
been us from Untold Wealth. Thank you so much for listening or watching. Devon Murphy, and
Vince Balak.
we will see you in the next episode. Leave us a like, 5 stars. We look forward to seeing you. See ya.
Cheers.